Question number 24. Following information relates to AKC Limited, which manufactures some parts of electronic devices which are exported to US, Japan and Europe on 90-day credit period. Okay, these are exported, so it means funds will come. You'll receive certain foreign exchange. Foreign exchange means what you'll receive. You'll receive dollars, you'll receive yen, and you'll receive euro. Correct? Now, cost and sale information is given to you for all these different countries. Variable cost is given to you. If you see, variable cost is in rupee. All these are in rupees. Okay, these small things is very important, especially in forex. Currencies are extremely important, so do not miss the currencies. Okay, export sale price is given to you. So sale price is given to you, say yen, dollar, euro, right? Receipt from sale due in 90 days. Total receipt which are due in 90 days also given to you, yen, dollar and euro. Okay, this is the individual sale price, this is the total receipt. So can I say from both of these things, can I get the quantity? Yes, I can get the quantity. Then I also have the variable cost, individual per unit variable cost. If I have the quantity and variable cost, can I multiply them and get the total variable cost? Yes, I can do that, right? Then foreign exchange rate information has to be available, because without this we cannot solve. So this is the yen per rupee is given to us, dollar per rupee and euro per rupee. Are these rates correct? Yes, they are correct. See, rupee is bigger than yen, Japanese yen. So 1 rupee is equal to 2.417. It looks correct. Then rupee is smaller than dollar. Rupee is also smaller than euro. So this also seems to be correct. 1 rupee is equal to $0.0214. Correct? So these rates are perfect. And they've given these rates for spot, 3-month forward and 3-month spot. That is the rate on that 3-month period date. Okay, and 3-month forward rate means what? The rate at spot today. What is the 3-month forward rate? I hope you are able to understand the difference between 3-month forward and 3-month spot. Okay, advise AKC Limited by calculating average contribution to sales ratio and whether it should hedge its foreign currency or not. Contribution to sales, okay, I know that. Contribution is what? Sales minus variable cost, right? Okay, so let's solve, but I'll just solve for one country. Okay, in this case I'm just doing it for Japan, and then you can do United States and Europe, because we do not have that kind of time, and this is a revision lecture. Okay, I'm just erasing this. Okay, so contribution to sales. For contribution, I'll need two components, sales and variable cost. Do I have total sales with me? Yes, I have that. Okay, total sales. Do I have the total variable cost? I do not have that. I have per unit variable cost, and I've also mentioned further how do I get the total variable cost. So see, if you notice closely, I have the per unit sale price and total sale price. So I'll get the quantity first. Quantity sold, you could say, units, which is equal to total sale price is yen 78 lakh divided by weight. I'll use different pen. Okay, 78 lakh and your sale price is 650 yen. This is not proper. Okay, this is per unit price. When I divide this, I get 12,000 units. Okay, for Japan. Okay, Japan sales, you could say, quantity. Then I have the sales with me. What I need is, for contribution, I need variable cost, total variable cost. So I can get that sales quantity into the per unit cost, 225. So therefore variable cost is equal to quantity into how much is variable cost per unit. Was it 225? Yes, and this is 12,000. So this comes up to 27 lakh. Okay, but what is this? This rate, what was this rate? Rupee, this is rupee. Okay, VC, total VC. Now I have that. Now can I find the contribution? I can, or can I not? I still cannot find the contribution. There is a reason to that. See, my total sales are given to me in yen and my VC, variable cost, is in rupee. So I cannot do this calculation. Both the currencies are not same. But more importantly, if you see, they've asked me to hedge, and that's the reason actually they've given me the foreign exchange rates. Okay. So since in the first option, let's do by hedging. What will happen if I hedge? Because they've asked also, see, whether the company should hedge its foreign currency risk or not. If it does not hedge the risk, then what should the company do according to you? Think about it. See, then they will use the 3-month spot rate to convert that yen into rupee. And if at all they will hedge, then they will use the 3-month forward rate. Because forward means what? Once again, I'm repeating this. See, use your logic. 3-month forward rate means what? Sitting today at spot, there is a rate in the market which is the forward rate that is quoted, that this at this particular rate, no matter what is the actual rate in the market after 3 months, your transaction is settled at this rate. Okay, today. So your inflow or your outflow, whatever the case may be, is fixed today. Okay, that means 3-month forward, or that means hedging. Okay, that you're fixing your cash flows, your inflow or outflow. And if you do not do that, if you do not hedge, then what you do is, then what you do is the final rate which actually exists on the market, and that would be 3-month spot. Okay, at 3-month period, what is the actual rate that is quoted in the market? So then you take that rate, because at the end of the day, you have to see, as an Indian, you are an Indian. How do I know that? The information is AKC Limited. Okay, not AKC company or something like that. See, company.co would be in United States, but limited, we know that, okay, this is an Indian company, and they've said that the foreign exchange relates to this, and you are exporting to all these countries. So this means that you are an Indian, because the other rate is rupee in all case scenarios. Okay, so by default, you understand there are various factors telling us indirectly that your exporter is an Indian. Okay, so when the exporter gets yen from Japan, the Japanese importer is, asking certain goods, say, to be exported to him, right? And they will make a payment in yen, say 78 lakh, to the Indian exporter. So this exporter will not keep that yen. It's also by law you are not required to keep foreign exchange above a certain level. You have to cash it and get your rupee, right? You have to convert that foreign exchange and get the rupees in exchange of that. So as an Indian, I have absolute no use of the yen. I have to give sell these yen to say, for example, the bank we are talking about in the foreign exchange market, okay, and the foreign exchange dealer, whoever. And then instead of that, by selling these yen, I will buy what? Indirectly, what I'm buying is rupee. I will see there are 2 currencies in this particular code. Just focus on Japan right now. Here there are only 2 currency, Japanese yen and rupee. If I sell yen, what does it mean? It means I'm buying rupee. Okay. I hope I have covered this in much detail. So when hedged, we take 3-month forward rate. Okay, so the rate is actually yen by rupee. This is the rate. It's a rupee quote. Rupee is the standard currency. So now sell this 78 lakh yen, or buy rupee. Both are the same thing. 2 currencies involved in the quote. What should I do? It's a rupee quote. Okay, rupee is the standard currency, so I have to deal in rupee. So I will buy rupee. Okay, now if you see, this is the quote that we are looking at right now. Buy at high or buy at low. Customer always at a loss. Customer will always buy at a higher price. Okay, in the foreign exchange market. So I'm buying rupee. It's a rupee quote. Hence I'm buying rupee. So I will buy at a higher price, which means this 2.427. This particular rate. Correct? I have my rate. 2.427, and this is yen by rupee. 2.427 yen by rupee, correct. And my exposure is equal to yen 78 lakhs. Correct? And I have a yen by rupee quote. So multiply or divide. I have to divide in order for the common currency yen to cancel out. 2.427. Yen will go. I will be left with equivalent rupee. 78 divided by 2.427 would give me 32,13,844. What? Rupee. Now I have rupee. What is this? This is my sales or total revenue, right? This is revenue from Japan in equivalent rupee terms, okay, in case I hedge. This is my sale in rupee. I have my variable cost in rupee. So now can I get the contribution? I think I can, right? So I'll just subtract this minus 20. Yeah, we get the contribution. Contribution is equal to sales minus VC, which is equal to, I just did it on the calc, 5,13,844.25. So this is, keep this way. Okay, this is your final answer. This is your contribution. This is also not your final answer. They're asking contribution to sales ratio. So we'll do even that. But the thing is, I'm not doing that ratio because you have to do it for the US market and for Europe, and then they are asking the aggregate, the average. Sorry, not the aggregate, the average. So when you add all this is when you get the average. So I'm not doing that. But basically it's contribution divided by sales. That's what they're asking. Okay, total contribution divided by sales, total sales. And in case you do not hedge the foreign currency risk, I'll even do that for Japan. So then what will I do? See, again the same thing I'll do, sell yen or buy rupee. What will I do? Again, it's a rupee quote. So I will buy rupee, buy at a high or low price. Customer always at a loss, customer will buy at a higher price. So 2.459, okay. If yen not hedged, then 2.459 was it? And this is yen by rupee. The exposure still remains the same. What was the exposure? This was yen 78 lakh if I'm not wrong. And yes, 78 lakh. You have to divide for yen to cancel out. 70 lakh divided by 2.459, 31,72,021. This would be my final answer, rupee. This is what? This is your total sales in case not hedged. So when you hedged it, see your income was more, 32 lakh. In case you've not hedged it, then the rupee equivalent inflow is less, 31 lakh approximate, 31,72,000. Okay, now we'll just go to the study material and see the complete solution is in front of you. I'll just give you an overview because we are revising. Okay, it's already 13 minutes in the sum, so it's like a long time. So if hedged, foreign exchange is hedged, what is your foreign exchange? And in Indian, your foreign exchange is yen, dollar, euro. Okay, see, I've done what they have done. See, the same thing. Units sold, they got 12,000, and by dividing the sale price per unit, then total variable cost they got. Then 3-month forward rate in case you are hedging. So see, 2.427 we took the same rate. So rupee value of receipt, rupee, we use the forward rate, 3-month forward rate to get the rupee equivalent of that yen receipt of 78 lakh. Finally 3213, we got the same amount. Then the contribution. See, but they are asking the average contribution to sales ratio. So you have to take a total of this, which comes up to this. And this contribution divided by the sales would give you this amount. Okay. And if not hedged, then the rupee value of the receipt would be this. How did they got this amount? I have calculated this just here. See, 3172. Correct? This is how you do this. This is basically the 3-month spot. Okay, the spot rate at 3 months, after 3 months, the actual spot. Correct? I hope you are able to understand this. And finally, they would have given the answer that should you hedge or should you not hedge, advice to hedge. Why? Because if you see the ratio, average contribution to sales ratio in case if it is hedged, then it is 19.56%. See, this ratio has to be higher. Okay, your contribution has to be higher, and contribution to sales if not hedged, then it is only 19.17. So it's better to hedge. Okay, thank you. Bye bye.